All right, so today we're going to spend time talking more about the multiples, extra credit, and the Costco uh, assignment. Probably not going to be able to finish up the conversation on group case 3 again. Probably postpone that till next week based on what happened in the previous classes. And also, we have some logistics issues we need to cover on things coming up. So, you want to go ahead and get your extra credit up for Costco. We'll go through that in just a minute. But while you're doing that, and you'll probably want to have your Costco as is from the homework that was due on this morning, for homework 9, I believe it was. But, Monday. So basically, as we look towards the end of the semester, and I have the assignments tab pulled up, we're down to one more individual assignment, which is due on Monday. And you'll notice there's a section for in-class assignments where there's some points left to do an in-class or basically called a final homework, or essentially homework 11. So here's what's going to happen. Today is Wednesday the 13th, homework 10, which will be available this afternoon at 4:30 Eastern. I'll at least describe it, the actual assignment, will be a version of what you just did with the Costco assignment repeated with a sanity check going throughout the whole model that you'll do for your group projects as well. Okay. Then for the final assignment, graded individual assignment, we will do it next Wednesday in class, which will be Wednesday, November 20th. But if you don't finish it in class, I'll actually make the assignment due Monday before Thanksgiving, so 2 weeks from Monday. Okay, so that will be the final class before your group projects are due, because the Wednesday before Thanksgiving is a university holiday, so happy Turkey Day. And so when you come back December 2nd and 4th, that's when you'll be working on and presenting your group project presentations. So I wanted to talk briefly about that. So there'll be more data published later this week on the specific rubric I'll use to be grading it. But I will say that generally the TAs have been grading all of your individual assignments this semester and the midterm exams. I actually grade the group projects myself individually, both the presentations and the papers. Okay, so I'll be very specific about what I'm going to be looking for. The deadline for turning in your semester-long group project on the company that you have chosen to do as a group, which is 20% of your semester grade, is Monday, December 2nd at 10 a.m. Okay, and you're going to turn in 6 files, right? So you're going to turn in 4 Excel model files, the as-is, the bowl, the bear, and the target. Then you're going to turn in a written paper, which is 8 of the 20 points, 2 points per section, and there'll be 4 sections that will be described. You'll then do a PowerPoint presentation either that Monday or Wednesday. You'll be in class both days. That will be 12 of the 20 points, 3 points per section for the 4 sections. The 4 sections in both the paper and the PowerPoint are now being covered in class. EIC is one of the sections, so you'll do an EIC and all supporting documents and data. You'll do a historical analysis, which is section 2, the ROIC tree and the CFI. Section 3 will be the valuation, the as-is, the bowl, the bear, the target, with your buy, sell, hold recommendation, and the associated sanity check, which we'll talk about today. It's part of that. And the 4th section will be the multiple analysis, where unlike the simple examples we've done in class, you'll do your company plus 5 others related to your industry. So for both the PE tab and the EV to EBIT tab for the 6 companies, and those will be what you're going to be graded on in your analysis. So the paper will be graded independently of the PowerPoint, but they both have to present all of the information. So what's going to happen is you're going to submit this all Monday, 10 a.m. That day, 3 of the teams are going to do a 20-minute presentation. You will all be here. We'll work out who's presenting on Monday and Wednesday, but you'll do your presentation on one of those 2 days. As soon as the presentations are done, I'm going to give you your grade out of 12 points, right, across those sections. So you know exactly how you'll do. I haven't read the paper. So everything is going to be graded based on what's presented that day, and you have to present everything that day, right, in the PowerPoint, including all of the supporting data, right? So that's going to be very important. Then, within a week, I will read all of your papers. Can't tell you how excited I'm going to be about that. Probably as excited as you were writing them all. But nonetheless, so I'm going to grade those. And I'm going to grade those without remembering what you said, because those are going to be graded independently. So you're going to present the same information in two different formats. And I'm going to grade each format independently. So if you said it in class, but you don't say it in the paper, you lose points. Right? If it's in the paper, but it's not in the PowerPoint, you lose points. So you have to put all of the information in both formats. Also, in your presentation, you will have 20 minutes. All the team members have to present. If you mismanage your time, and even if it's in the PowerPoint, and you don't get to it because you run out of time, you lose points. So you got to basically think about 4 sections, 5 minutes a section, got to be efficient, right? Because each section carries equal weight towards the grading. Same thing with the paper. So 20-minute PowerPoint, which could include Q&A, by the way. And then the paper, probably about 30 to 40 pages for your paper. So before you go get all freaked out, basically that includes all the exhibits. So essentially 2 to 3 pages per section. So a 2 to 3 page write-up on EIC. You've already been doing that for your assignments. A 2 to 3 page write-up on the CFI tree and the ROIC, the ROC tree and the CFI. 2 to 3 pages explaining all 4 of the models and changes of assumptions, and a 2 to 3 pages on the multiples and explaining the 6 companies, premiums or discounts across the various multiples for them. So that's really what you got to turn in, and then supporting data and exhibits. So just kind of giving everybody a preview of that. The final thing I want to say about the group projects is that there's definitely an advantage to going on Wednesday versus Monday. And we'll work out next week who's going on Monday and who's going on Wednesday. You're here for both days, so it shouldn't really matter. But the point of the story is, what the teams on Wednesday will be able to see is they'll see the presentations on Monday, and they'll probably hear about the grades. So they'll know where the holes were and what was good. And they'll probably adjust their presentations accordingly. So to mitigate against that, whatever you turn in your PowerPoint on Monday is all I will grade. All right, so you won't be able to talk about things that aren't in your PowerPoint, and you won't be able to jump outside the PowerPoint to show me information. So for example, oh yeah, I forgot to do the sanity check. So therefore what I'm going to do is I'm going to pull up my Excel model that shows you the sanity check. I'll let you continue on for time, but you get no credit for anything you say there. So if the sanity check wasn't part of the original PowerPoint that was presented, then it doesn't matter. You're not getting credit for it, whether you talk about it or not. So all the data and all of the material have to be submitted before you do the presentation, and I will only grade on what's in the presentation and talked about. Same thing with the papers. So those get locked in that Monday. Just want to give everybody a heads up. Question?
So for the presentation, you're not allowed to talk about anything that isn't on your slides.
If you do, and I'm just saying it'll be a judgment call, but what I'm saying is if I think that you're basically talking about things that should have been in there and there's no data to support it, I can't give you credit for it. So for example, and it's usually more glaringly obvious, which is what I just said, like you'll realize, oh yeah, we forgot to do the sanity check on the bull and the bear, and everybody else did. So you start talking about why it's a reasonable stock price, but there's no data to support it. It's clearly you didn't do the sanity check. I can't give you credit for that. All right. But if you're talking about the operating ROIC and you're doing your EIC and you're giving me more data about why it's a positive, spread and what is really going on with the customers, which is more than what you have on the slide, all right, I'm not going to necessarily dispute that you're going to give me supplemental data. But the real point there is that, for the specific requirements, you should have the supporting information. If you don't have the supporting slides, screenshots, Excel data, then that's the one that you'll lose credit for. But it's a good question. All right. Any other questions about that? All right. So that week, the Bloomberg Trading Challenge ends. So make sure you complete the trading challenge and submit all of the data. You got to have at least 10 new trades, and make sure that you're staying in not in cash. I am going to be looking later today to see if the 2 teams that were on warnings are still in cash. If they're in more than 20% in cash, they will be disqualified from the competition accordingly, but because they were warned on Monday. But regardless, basically the trading challenge data will happen sometime that week. The TAs will also check for the final exam opt-out criteria. So by Thursday or so of that week of December, about December 5th, you will know whether or not you have to take the final exam on December 9th. So our final exam is actually on the final day of class. It's not during the exam period. So basically, because once you do the group projects, everything's anticlimactic. There's no new material. And so basically, the final exam is December 9th. So what will happen is, if you opt out, then your final day of class is Wednesday, December 4th. Okay? Otherwise, for the people that don't opt out, you'll have to take the exam on December 9th. The exam will be similar in format to midterm 2. Okay? But nonetheless, you'll have to take that final exam. Last semester, about 80% of the people opted out. I hope it's a higher number this semester. I haven't checked. But again, you can talk to me about the opt-out criteria. But basically, if you did miss an individual assignment, remember there is these, and down here is where you'll find it. You can take this assignment replacement to replace an individual assignment. It doesn't count if you miss one of the group projects or if you did poorly on a midterm exam. That will not let you opt out. But assuming you did all the projects, didn't score less than 50% in an individual assignment, and if you did at least one, did the assignment replacement, you can then opt out, which basically means you'll get a full score on the final exam without taking it. Okay. Yes.
What are the details of that replacement assignment?
It's right here. It's basically what you do is you write a 500-word paper and you submit it. And as long as you put the paper in, has the word count, and talk about the topic, then basically we'll consider that a replacement for the worst scoring individual assignment. So what we'll do is we'll look at the worst scoring individual assignment, replace it with a full grade, and even if you missed a deadline, we'll treat it as if you didn't miss the deadline. Okay, for one assignment. Any other questions about that? Just kind of covering logistics through the end of the semester. All right, if you have any more questions, please let me know. So let's talk about multiples and the extra credit assignment. So back here in Excel, all right, so basically what we did is set up for today for the 2 tabs, Costco, Walmart, and Target. Okay, and that was the data for the 3. So again, this is also what we covered on the exam and would cover on the final if you were taking it. And this is what you'll be doing in your group project. The only difference is instead of 3 companies, you'll have 6 companies. But the idea is, why is your company, in this case would be Costco, trading at a premium or discount to others? So in terms of Costco versus Walmart, what would you say? Why is Costco trading at a PE of basically 32.66 versus 23.17? What do we now know? Yeah, go ahead.
One thing for sure, the expected growth in net income is a lot higher for Costco at 5.75, whereas Walmart's is 3.58.
Yeah, and your number's slightly different, but close enough, and that's the point, depending on when you do the share price. But that's exactly the primary reason. I really like the fact that you use the numbers. So don't forget to always do that in this class. That's just what we do. And you could also say, at a similar spread or at least similar cost of capital. They have a little higher cost of capital. But regardless, it's really clear that's that higher growth rate, which is why they have a higher multiple. Right? Why is Target trading at a discount to Walmart in PE? Why is Target trading at a discount to Walmart? Yeah.
The growth also.
Okay. I'd love to give you credit for that, but to be more specific.
The Walmart growth rate is 3.59%, and the Target 3.58% yours, and then the Target growth rate is 1.65%.
Okay. So that's great. And what else could you say about the spread there?
Oh, and Target has a bigger spread.
Yeah. So despite the bigger spread of 27.4 versus 7.4, it's the lower growth rate that's causing them to trade at the discount. All right. But nonetheless, they actually do have a bigger spread. Okay. And so, like I said, there wasn't anything really tricky about this. And so essentially, this would be a relatively straightforward one. I can't promise that it won't be harder to explain some of the other ones you're going to deal with. But nonetheless, this is what we start to get into. All right. So then we go over to the other tab. And we do similar things with the enterprise value multiples. And essentially probably notice a similar story. So again, Costco is trading at the higher EV to EBIT, right? And again, primarily their G in free cash flow, 5.18 versus 3.49 for pretty similar tax rate, and again, higher spread. So it's both growth, 5.8 versus 3.5, and spread of about 23 minus 7.7 versus 10 minus 6.1. That's why people are paying a premium for Costco. And again, Target, despite the better spread and some more whack, it was the lower G of 1.19 versus the 3.49. So pretty consistent, by the way, between the PE and the multiples. They're telling the same story. So it's not really a big difference between what's happening at the operating level and what's happening at the net income level. Okay, so they got pretty clean PEs. That's another way of saying that. We also know that people are paying more for Target sales. People are paying 83 cents for every dollar of sales at Target, but they're only paying 75 cents at Walmart and Costco. And the primary reason is because they have higher margins. And that's what we normally expect in an enterprise value to sales ratio. Companies generally have higher EV to sales if they have higher margins, assuming similar cost of capital, which is one of the nuances we saw in the last example. But nonetheless, at similar cost of capital, the higher margin, 4.5% no plat versus 2.4 and 3.1, is why people are paying 83 cents per dollar. But here's the other interesting thing that we see in the analysis is that Costco is also getting a higher return because they're far more efficient. They're only spending 11 cents to drive a dollar of sales, where Target and Walmart are spending 30 cents and 37 cents respectively, right? And if you think about it just based on your own experience, if you're ever going to Target, you'll notice two things. Number one, they're jammed packed, okay? So they just got huge volumes. People are always in there, and you tend to have to buy in bulk, so they're buying more expensive things a lot of the time, and they're buying a lot of sales. So lots of sales out of that warehouse club. The other thing is you're walking into a warehouse. Like, there's not a lot of elegance to the stores of a Costco. It's literally a warehouse. And so they're just not spending as much on their supply chain as everybody else because they really don't have stores. You're just buying it right out of the warehouse. So that model gives them low investment, high sales. So even though they have a low margin, translating to really good ROI because they're selling again and again and again, that efficient model. And so that's the point. Like, Costco is winning in the valuation model, not because of their low margins. They're winning because of the productivity, which is driving their ROI. So something else that we kind of noticed by doing this multiples, even before we got into our as-is valuation. So this is pretty straightforward. There weren't really any surprises in any of the data we were looking at. This is the multiple analysis. And by the way, we're going to practice this. One more graded assignment, as I said, in class next Wednesday, which will turn into a homework due the following Monday. Okay? Yes, sir.
So homework 10 is it due this Monday?
Homework 10 is a different assignment. It is due this Monday. But this is going to be the equivalent of what we'll call homework 11. It's the in-class assignment that I'll make due as part of a homework. Okay? But so I'm just saying, I think it's important to keep repeating this because this is just something you're less used to. So we will repeat this one more time for a grade assignment before you do your group projects. Right? The other assignment, which is due Monday, is based on multiples. So now I want to transition to multiples. First thing, we also did, besides the multiple analysis for the extra credit, we did the Costco assignment that was due on Monday, as is Bull Bear Target. So the first thing I want to mention about that is when we do the valuation and we do the multiple analysis, you should do these at the same time. And the reason why is because, for example, when we did the as-is price for Target, we had to put in an assumption for G. That G in our model should be the same G as this G in our multiples. So that's what I mean by, like, there's one price for the company, and if we're doing it to the same price at the same time, we should have the same G here that we actually have in our model, right? And so the reason why they're somewhat different is just because we started building the model a month ago. We hadn't yet put, let's minimize this here. We hadn't yet put, there's a lot of windows open. Way too many windows open. We hadn't yet put this multiple spreadsheet together. So we recreated the multiple spreadsheet for Costco right here, right? But essentially, that's the point. We should be using the same G. We should have the same ROIC as the future ROIC. We should have the same WACC in our as-is as we do from the multiples. So these should be in sync. The other thing that should be in sync from our multiples is down here. We have an estimate for Costco's productivity of 11 cents into the future from the multiples. So I know we said we didn't really change the balance sheet that much, but on the ratios tab, this row right here should be 11 cents in the future, and it basically is. So one of the reasons I said is, look, companies don't change their productivity that much in the future. Costco isn't expected to. They're expected to be very efficient even into the future. That's reflected in their share price. That should be reflected in our as is. So it just reinforces that for Costco, we don't really have to worry about changing the balance sheet. The level of productivity is constant. But if this number were like 0.16 in the multiples and 0.11 in our as is, we probably need to make an adjustment to move our as is to 0.16 to reinforce the as is to be reflective of the multiples. So we got to triangulate. So one of the important themes is behind everything I'm saying is you have to do, for this class and good practice in the real world, the multiples at the same time you do the valuation, right? Because if you do them at a different time and you're valuing your DCF at one price and your multiples at another price, you're not going to be able to sync up. And I do want you to be able to sync up. So the people, when you do your group projects, that's what's going to be important. When you do your group project, which is a far more impactful part of your grade, let me tell you where the group projects typically have run into trouble in the past. Basically what you do is you assign your team and everybody has their section and they don't talk to each other. And then you come in and they're not in sync. So basically the people in the multiples are like, oh, my G's like 5. And then the people that do the DCF, oh, my G's like 4. Well, why are they different? They shouldn't be different, right? Or even more fun, the person that does the EIC says, this is an awful industry, right? It's got, horrible power of buyers. It's got tremendous supplier power. It's easier to get into and out of this industry. And we actually think the industry is going to get worse over time. And then the person that's doing the valuations, a buy, and they're showing great growth, great G, great spread, great increasing margins over time. And I'm just sitting there trying to grade you like, are you even talking about the same company? Right? So what I'm also saying is, I know the method is division, everybody split up, and then you just throw it together at the last minute. That doesn't work nearly as well in the class because these should be synergistic, meaning the EIC is there to help you do the valuation, helps you think about what the future assumptions is, and reinforce why you're changing the ratios. The as-is model and the multiples should be syncing up. And if they don't sync up, then it's going to become pretty obvious that you're actually not talking about the same company at the same time. So this is the important part of the integration work you're going to need to do with your teams. So I'm just giving you a heads up to make sure that you're as successful as possible. But that being said, we got to do one more thing to this model that we haven't done, which involves Bloomberg. And that, after we do this, we'll then put the model in the lockbox. And we'll leave the model in the lockbox, and we're not going to change it anymore. We're going to make one final change, and this will involve your homework for next Monday. So we'll start out with Bloomberg. We're going to go to RV. Sorry, every time you do a trade, I get an email. 26 teams, lots of trades, lots of emails. All right, so back to RV. Go to Costco. This list that you end up using, and I'll have you have some discretion, should be the same list you do in the EIC section to do the industry average for beta, for industry spread. Should be the same list you use for your multiples that you will pick the 6 companies from, and to get the sanity check, which we're about to do. So this is important which list you choose. Now, whether you use the analyst curated, whether you use the best fit algorithm, GICS, whatever, I'll let you have some discretion. And by the way, when you choose the companies, choose companies that are realistic. So for example, if Costco is your company, like I think Walmart, Target are probably a reasonable alternative, Big Lots, etc., 5 below. Probably wouldn't put Tiffany on that list. Probably wouldn't put Nike on that list. Right? I wouldn't call those really comparable companies to Costco. Right? So again, you'll have to use some discretion on that. But from this list, go to custom. We're going to create a saved template that's going to be reused. So you'll start here. And in the custom template, where it says add column, type in EV space 2, TO, space sales. This is the enterprise value to sales or revenue multiple. Now, you'll notice as Bloomberg searches its database, there are two fields that already exist. EV to this year's estimated sales, enterprise value to forward year 1. EV to next year estimated sales, EV to forward year 2. So just as we're using in this class forward multiples, the real world does too. So Bloomberg helps the analysts by giving them these ratios by default. So they already have them predefined. Okay, so we're going to take EV to next year's sales, hit enter, select it, hit enter, and we're going to have the EV to sales by company, and more importantly, the industry average. Okay? 0.75 right now for Costco. Right. Now here's the thing. This 0.75 for Costco should be the same, my spreadsheet, 0.75 that I put into my multiples for Costco for EV to sales earlier. And more importantly, that's the thing. So one of the benefits of the template that I'm about to show you is rather than going through screenshot by screenshot EEO and then manually taking each of the multiples and putting them in for all the competitors, you can have a template that gives you all of it right on the screen. So it saves you a little bit of time and is a little bit more efficient to doing the analysis that you're about to do. So back to this. The next multiple that you're responsible for that we want to put on this template, and it's also important to have an industry average, is EV to EBITDA. So enterprise value, EV, space TO, or you can also use divide, and then EBITDA. And since there's more than one EBITDA on here, click on Show More Matches, and it'll show you the other things it finds. You can scroll down, and in this list of search results, you'll see that they have an EV to this year's estimated EBITDA and an EV to next year's estimated EBITDA. Select EV to next year's estimated EBITDA. There's the definition on the right. Hit update. Now I have an enterprise value to EBITDA for the second forward year, industry average, as well as each of the individual companies. Okay. Now what I'm about to do, I don't need you to do, but I want you to understand that Bloomberg is a very powerful tool. And over the years, there's multiple ways to cut the data and to get at the data that you're looking for. So another way to get to the same data, so Bloomberg has just standardized these searches to make it easier. But if you had typed in EV to EBITDA, one of the things you would have seen in your filtered results is an EV to best EBITDA. Best stands for Bloomberg estimate, as in consensus estimate database. So what I can do is EV tapped into the consensus estimate database directly. So if I choose this, it'll say which EBITDA do I want from the consensus estimate database. Do I want one based on blended forward 12 months, current quarter, current year? Do I want a customized period? Do I actually want to look at an EV to EBITDA analyst guess 3 years ago? So I can actually look at historical guesses before I see the historical actuals. That's right here in the database. But what I want to show you is if I switch customized period, and if I switched to years, calendar years ago forward, then what I can do, I'll do years ago forward. Then I can go forward year 1, year 2, year 3, year -1, year -2, minus year 3, etc. So what Bloomberg did with the field that we put in, EV to next year's EBITDA, is the same as EV to Y plus 1. Now this is where Bloomberg gets complicated because the nomenclature is not the same. So in the consensus estimate data, the Y year is next year. It's actually what we would call the Y plus 1 year. And the Y plus 1 year in the consensus database is the second forward year. So even though it's the second forward year, it's Y plus 1 in the consensus database. That's why I'm not having you do it this way. But if you hit update, slight change in stock price in the last minute, 17.57 versus 17.58. But basically, this is if I do it manually. This is if I use their commonly saved one. Yes.
Is there a reason that commonly saved one wouldn't show up?
Well, what I'm saying is EV to EBITDA does show up next year.
Have you found it?
You got to hit in search results because it's buried in the search results. So what I'm saying is Bloomberg knows that people use this number a lot, so they created a specific field to search directly for that number. But you can actually, it's more powerful than that. You can look at the best database, or you look at historical database, and basically look at an EV to any EBITDA that you want. And so there's some ability to do that more granularly. Now, I didn't want to confuse you because you'll notice that even though it said EV to EBITDA Y+1, when I actually put it into my template, it's the second FY. And this is where it just gets a little confusing because you're in the consensus database and Y is actually Y+1 someplace else. So regardless, just use what I told you the first time. So I'm going to kill this. All right, third data point. That was just more for your Bloomberg news. EV to EBIT, same thing. Show more matches. Scroll down. Enterprise value to next year's estimated EBIT. Select it, update. And the final one is you can type in P divided by E, P/E. And what I want is the estimated PE for next year, which I could have also gone into the best PE, and then I could have done PE for Y+1. But regardless, estimated PE for next year. So this also gives me an industry average PE as well as individual PEs for the companies.
What was that last time?
Estimated PE next year, which is the second forward year PE. All right. So this is the template that you can save, but if you want to, I did this with the previous classes, optionality, you can put the price to book multiple in here. So if you want to type in P/B, it's price to book ratio. It's the current one because there is no future price to book multiple. It's just current price divided by the book value. And hit enter. That would be the price to book. But as I said on Monday, I'm not holding you accountable for understanding price to book because it's very distortable by accounting nuances. So I don't know if Costco having an 8.7 times price to book is because of their spread or if it's because they've done weird things with their equity. I'd have to dig around to try and figure that out. So it's not as necessary for the valuation of this class. That's why I'm not, even though it's in the slides, I'm actually said you need to know 6 multiples. I'm taking off the list of the ones I'm forcing you to know and do. So if you want to put it in here, you're welcome to, but it's not something that you're going to need to do to complete your assignment. But nonetheless, that's the price to book multiple. And the other one that I completely skipped on Monday was something called the PEG ratio. Okay, and so again, optional, not going to cover PEG this semester, but the general idea is the PEG ratio is you take your forward PE and you divide it by the growth in EPS. Except just for fun, the convention is not the growth in GPS in a perpetuity, it's the growth in EPS for the next 5 years. So price to earnings multiple divided by 5-year EPS growth is Wall Street's definition of PEG. So the reason I don't want to do it is, number one, it gets even more confusing because it's a different G than what we're using even in the PEG, even though they call it a PEG. But more importantly, the point of the ratio is what it says is if your PEG is above 1, it says for $1 of EPS, what is the dollar worth? So if your PEG is 2, that means for every $1 of EPS, I get $2 of value, $2 of PE, right? If the PEG is 0.5, that means for every $1 of EPS, I get 50 cents of value. PE is half. So the point is, it tells you how much your share price should change for every $1 of EPS, right? So essentially, people will use that as a rule of thumb for overvalued, undervalued, but I don't really want to talk about that because I think it just makes things more confusing right now. So price to book PEG, which is accounting distorted, is basically something I'm leaving out to the side. You need these 4 ratios. If you want to throw them in and play with it, feel free, but you need to have at least these four. EV to sales, EV to EBITDA, EV to EBIT, and PE. Once you save this template. Either hit save or hit gear and then save. Okay. And I'll save this as multiples, or whatever you want to call it, because you're going to reuse it. Okay. Once you have saved this template, and make sure you did this. People had trouble with this in the last class. Go to Settings, Global Settings. Make sure where it says Excel Export Mode, Static Data. Don't export dynamic links. It will cause you problems. Static data means give me numbers. Then export this to Excel. So I now have this template in Excel. Take the worksheet that was just exported and rename it. Click on it, rename it multiples. Okay. I'm calling mine multiples video, but you should call yours multiples. Then, with this spreadsheet open and your Costco as is valuation model open that you turned in, what I want you to do is take the spreadsheet, right-click on the tab, hit Move or Copy, switch to the workbook Costco as is valuation model. Before sheet, scroll to the bottom, move to end, hit OK. What that's going to do is it's going to take the tab that you just exported the multiple data, it's going to move that entire tab to become the last tab in our as-is valuation model. So those are the multiples for Costco and all of its peers right after the valuation tab in our model. Questions about what I just did? Anybody have trouble doing that? Okay. Then take row 1 of what you just inserted, highlight row 1, insert a row. So that row 1 is blank. And in cell A1 of the worksheet you just imported, call it the model multiple. So this is the EV to sales of Costco next year. This is the EV. This income is the sales for the second forward year. EV divided by sales is EV to sales. So we have the observed EV to sales of the real world, and we have the EV to sales that is forecasted in our model. And since we did as is valuation with a share price that's about the same, these numbers should be very close together. So the enterprise value to sales multiple that our share price comes up with in our model should be the same or very close to the enterprise value to sales multiple that we see in the real world. That's what I'm going to have us do. Okay, so 0.75. It's 0.75 in the real world at a $300 share price. It should be about 0.75 in our model. But here's the problem. Go to our valuation tab. The way we calculate enterprise value and the way Bloomberg calculates enterprise value, as well as all the economic textbooks, are different. That's going to cause a problem, because if we use our definition for enterprise value and divide by sales, and Bloomberg has a different definition for calculating enterprise value and divided by sales, we're not going to get the same numbers. And so we're going to have an apples and orange problem when we try and compare what's in our model to the real world. So what we're going to have to do, so in cell E18, I want you to type in BEV, which stands for the Bloomberg Enterprise Value. And in cell E19, we're going to calculate enterprise value using our data the way Bloomberg does in our model. So we have a clean definition of Modigliani-Miller, cell D19, and then we'll have the same way Bloomberg calculates it, which will be in cell E19, which we'll use to compare against those external multiples. Right? So theoretically, they should be the same. Fortunately, they're not, because we're using, in the McKinsey approach, a clean definition of Modigliani-Miller. The real world is using a shortcut. So let's talk about the shortcut. Go back to Bloomberg. For Costco, type in FA. The first screen of FA is how Bloomberg calculates enterprise value. The formula is right here. So how do they calculate enterprise value? What they do is they start with the market cap, which is the value of the equity. They subtract all of the cash, not the excess cash, all cash. They add in all the preferred and non-common equity, and then they add in all the interest-bearing debt. And that's called enterprise value. So let's compare. What we did is we started with the common equity value, added in the rest of the equity and the debt, and we call that enterprise value. That is the equity, the debt, and the other equity, the preferred. So that's the same. But here's where it's different. They then subtract all of the cash. So if we were to take enterprise value and subtract all the cash, what number would we be close to? If we take this minus all the cash, what number do you think we would be close to? In the model. Actually, the operating value. So that's the point. The way the academic textbooks, which were written 30 years ago and are in version 9 and 10 today, and the way Bloomberg calculates enterprise value and hasn't changed, is actually what Modigliani-Miller would call operating value. The real world definition of enterprise value is closer to operating value. It's the value of the free cash flows. What it is, net debt plus equity. That's the definition they're using. Okay? And so, two things. Here's the challenge. Number one, even if we tried to do this, are we subtracting all the cash when we do the net debt to get to an operating value? Would we subtract all the cash? In this class, no. What cash would we subtract? What's the non-operating cash? Excess cash. So what Bloomberg is doing is it's not differentiating between operating cash and excess cash. It just subtracts cash. So that's going to be one of the first differences in the operating value that we would calculate from free cash flow and the way they would back into it from subtracting all the cash. Number two, they only subtract the cash. They don't deal with any other non-operating assets, and they just assume what's left is operating, right? And this is why I made the comments. It's almost historically laughable, but a month ago I said, look, when I went to Wharton, it was a simpler time when these first ratios were being put together, and Michael Bloomberg was starting his company, and all the academics were solving the ratios because there weren't a lot of non-operating assets. Cash was really the big non-operating asset. So when they did the original formulas, they tried to sync it to Modigliani-Miller, it's, hey, enterprise value minus the non-operating asset of cash is probably the operating value for almost everybody out there. So having other non-operating assets at the time was the exception. It wasn't the rule. Well, the world has evolved a lot in the last 30 years. So instead of very few companies having a bunch of non-operating assets, now we got a lot of companies that have non-operating assets, but the formulas haven't changed in 30 years. And so that's what's being represented here. So that's why the value we're creating academically in our models actually works out much more straightforward. Unfortunately, we're dealing with two shortcuts that were made in the real world 30 years ago. Shortcut number one is they only treated cash as non-operating, and they never split cash into excess cash and operating cash. So let's recalculate enterprise value with data in our model to the Bloomberg approach. So it's the same debt and equity. It's the same enterprise value minus all cash. So what we'd have to do is go to our balance sheet, So for cell E19 equals D19 minus from the balance sheet, historical, so 2019 is column G, minus operating cash, which is G4, and minus excess cash, which is G5. That is what I would call the Bloomberg enterprise value calculation. So column D, straight Modigliani Miller. Column E, real world calculation of enterprise value. But here's the reason why. That's a number, if I want to do an EV to sales, that would sync up with what we just imported in. Yes?
Should be equation real quick.
So just the debt and equity, which is basically what we call enterprise value, minus all the cash. Balance sheet G4, balance sheet G5. So, long story coming to an end. Go to the multiples tab you just imported. Go to column D, cell 1. Enterprise value to next year's sales equals. Go to the valuation. Take the BEV, E19, that we just calculated, divided by, go to the income tab, forecast year 2, 1, 2, I, 3. At our current share price, 0.744, 0.744 is basically the EV to sales based on the share price of the model, and rounded off in Bloomberg, 0.75. Now again, it's a couple of nuances between the real world and ourselves, and matching the share price exactly and other things, but nonetheless, pretty darn close, and it should be. That's the point. We should come up with the same value as the rest of the world doing the same approach. Because we came up with the same share price, we should come up with a very similar multiple. This is the as-is of the multiples, and the syncing up of the two. We're going to repeat this for 3 more times. EV to EBITDA. In our model, EV, cell E1 off the valuation tab, it's going to be E19. And we're going to divide that off the income tab by I, second forward year, EBITDA, I8. EV to EBITDA in our model, 17.48. EV to EBIT equals, from the valuation, E19, divided by, from the income tab, second forward year EBIT is I10. And the final one is the PE equals, for G1, from the valuation tab, the price is cell D26. That's the equity value, divided by the earnings from the income tab, I25, which is net income. Now you'll notice when we get down to PE, there is more of a difference between the PE than there was in the proximity for the second forward year, EV to sales. Part of it is you have to remember how we built our model. When we were forecasting the future years, we did things like, don't change the interest expense. Don't change the excess cash interest. Don't change common FX in the future, make FX 0. No one-time gains or losses. When we made those assumptions, we're also differentiating our forecast profits slightly from the real world, because the analysts sometimes will actually forecast that. Okay, so that's the point. Like, those numbers aren't going to be exactly one-on-one, but they should be pretty dang close. And that's what I want you to have in your as-is. This is the file to save. This is the now final model that you are going to submit for next week's homework assignment and for your group projects. And this is what we're going to use to do the sanity check. So now let's talk about what I mean by sanity check. So as part of your Costco assignment, in addition to doing the as-is, you had to do a bull, a bear, and a target. So let's talk about the bull. So I now am going to take this model, I'm going to save this, I'm going to start working on my bull. Okay, got my bull. All right, so I now work on my bull. So I come in here, and basically I'm going to go to assumptions, and I'm going to write lots of pretty words and sound really authentic, and I'm going to tell you the rosy story of why the G should be 6%, not 5.2%. Blah, 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 6%. It's part of my write-up. Then I'm going to tell you, off the ratios tab, why the EBITDA margin in the future, instead of 4.3, is going to climb to 4.6. They're going to get 20 basis points more of EBITDA margin for the following reasons that I just made up, but sounded really exciting, because they should be realistic, and I'm really smart. So therefore, I'm going to change that to 4.6. Add 20 basis points, right? And I'm going to tell you about their international expansion. So therefore, they're going to get more sales than 7%, and they're going to get 8% for the next 3 years, not 7% for the next 3 years. And I'm going to sound authoritative. And I didn't really make substantial changes, and they all sound very believable. Well, when I put that together, that's a $472 share price. Okay? That's my bull. But the real question, is that reasonable? And the point is, any of those three changes are not completely unreasonable. If Costco goes outside the US and aggressively expands its model, you could actually say their G should be higher. And you could say that they 20 basis points, heck, you've seen how crowded they are. Raise their price by 0.2%. They could probably get some more out of their supply chain if they really wanted to. The analysts have been pushing them to do this for years, and it's selling higher margin goods. And then the other piece is that they're going to grow a little faster with their expansion if they open up a few more stores. I'm not saying that this is an impossible number, but here's the problem. When you multiply these things together and compound this into infinity, that's where it starts to become unrealistic. But any individual choice I made didn't seem so unrealistic. So maybe I start convincing myself that this is possible. And Costco's, at the bull end, pretty undervalued. And it even influences how I do my target. So here's what I mean by sanity check. So then I want to go to the tab that we just imported into our model. And I want you to look at this. To get to that $472 share price, that's an EV to EBITDA of 27.62. So I'm going to go to a mutual fund, BlackRock, and I'm going to convince BlackRock to buy Costco and pay 27.6 times next year's EBITDA. Are they going to buy it? Here's the rest of the industry. I'm going to go to BlackRock and convince them to pay a 49 times PE for Costco. Do you think they're going to pay 49 times Costco's earnings next year? This is what I mean by sanity check. So what the multiples do is not only do they help us get data about basically assumptions to help us do our as is, but they also make sure that some of the assumptions, especially with compounding, don't get too out of line. I'm not saying this is not theoretically possible, but there's nobody in the industry that they're paying these types of multiples for. So if I say this is my bull, it's probably not going to be believed by anybody. And the chances of people paying this multiple for Costco in the next 12 months, pretty darn slim. So this is not a realistic bull. That's what I want you to do differently that you haven't done yet, is that when you do your bull, do the sanity check on the bull and tell me that this is a realistic bull. And I can't tell you exactly what the bounds are, because you could go higher than the range of the industry, but you got to have a pretty good, compelling argument for why you're going to beyond this. So here's the point. If I look at EV to EBITDA as an example, Costco's trading near the higher end of the industry already at 17.6 against an industry at 13.6. So the highest in the industry right now is 5 below at 21. So if I start getting to 18, 19, 20, I think that's actually a pretty good bull. I start going past 21, 22, even the smaller company growing much faster. It's going to be hard to believe that Costco is going to really change that much in the next 12 months. So again, it starts to help me refine my bull. Same thing with my bear. If I do a bear and I say the EV to EBITDA next year is going to be 4, well, realistically, somebody's going to pay 4 times earnings for Costco. Like the worst player in the industry now is at 7 times EBITDA. So maybe I'm being a little bit too aggressive about my bear scenario. I'm not saying we can't have Armageddon, but at the same time, is this really the realistic bear for what people are going to pay in the industry? So it just kind of helps me set boundaries, right? So again, I can't tell you exactly where to set the line, but at least I'm giving you data to say, all right, here's my assumption, here's the rest of the world. How does that look given what's out there today? Is that something that seems reasonable to me? So that's what I'm adding to our model. That's what I need to do differently. And then the final part is how it affects your target valuation. If you do a hold, if your target price is a hold, should you have to do a sanity check? Yes or no? If your target price is a hold, should you have to do a sanity check? I'm sorry?
Hopefully not.
Well, you can, but should you have to? And I would say that's the one time when the sanity check doesn't matter. Why? Why would I say the sanity check is not necessary for a hold? Yeah.
I mean, you're kind of assuming that everything's already fairly valued.
Yeah. If people are already paying the price for that stock, I don't have to say that people are crazy to pay the price for the stock. Like they're already paying that price. So that's the point. The hold is not the reason why you do the sanity check. It's for your buy or your sell. So if you have a buy or a sell, you got to do a sanity check. If you have a hold, you don't have to do a sanity check. But for purposes of this class, I still want you to have the data for the sanity check, even if you have a hold, just because I think it's like brushing your teeth. It's good practice. But if I'm presenting in 3 weeks, the person presenting, if you say target, they need to do sanity check talking about the bull and the bear, and they could just say, look, we didn't do a sanity check for our final recommendation because it was a hold. And that would be sufficient. You don't have to explain that, because it's in the narrow band. But nonetheless, this is the piece that's the missing link to getting your models complete. And as I said, if you put this in, I'm not going to make any more changes to our model between now and the rest of the semester, but this is an important piece because the one thing that we have been missing to this point is a reasonableness test on the assumption changes that we're making. So we did the kind of the reasonableness test on the as is. The reasonableness test on the as is was we basically use the multiples to kind of pull assumptions to recreate the share price. So it helped us put in reasonable assumptions. But we never had a reasonableness test for the bull, the bear, or the target. This is the reasonableness test for the bull, the bear, and the target. And again, I'm not saying you have to always be within the range of your peers, but if you're going outside the range, you need to know you're going outside the range, and you got to have a really compelling story, right? Because it's just going to be harder to believe that in the real world, because what you're saying is you're seeing something that nobody in the industry sees. I'm not saying it's not possible, but I'm just saying it becomes highly improbable. So it's just make sure that we don't start, because again, the multiplicative effect, small change, small change, small change, small change, multiplied into perpetuity becomes much bigger changes than we realize. So anyways, questions? Comments, concerns, crippling fears. Now's your time. All right, so for Monday, you're going to do another company. It won't be Costco, and it's going to be a different industry. And you're going to do what we just did. Basically, the bull, the bear, the target, and the as is. Right? And then you're going to basically write it up and explain it just as you did, and you're going to do a sanity check when you do it. Make sense? Okay. So I'm going to do it myself, and I haven't done this. So I want to understand whether the model balances the CFI or not. Because the model doesn't balance the CFI, I didn't want to make that part of the assignment. Because remember, you have to have a balanced CFI or else bad things happen to your grade. So I'm going to assume that this is the company, and you guys can try it right now, because I'm going to do it right now, of what the company is. Otherwise, the assignment will be available at 4:30. But for the purpose of the video, I'm going to stop the video right now.